I've got some huge news to tell you. Options Academy has officially launched. It's a 5-lesson online course designed to teach you everything you need to know about options trading at the beginner level. And in this video, I'm going to dive into one of the lessons that you'll get when you choose to become a member. So let's jump into the Greeks and show you how they affect options pricing. Now, these four babies here, Delta, Theta, Gamma, and Vega, are known as the Greeks. There's a couple more that also exist that we're not going to get into today. We're going to keep it very basic. And we're actually going to focus primarily on the Delta and the Theta. These are the big two you need to know. I'm also going to tell you what Gamma and Vega are, just so you're aware of them, what they are if you see them in your trading. But these are trading metrics you can actually use to understand better how options contracts pricing will change. Kicking things off with Delta, it is a measurement of how much an options price is going to change for every dollar that the underlying stock price changes. And we're going to show you an example on the next slide to really make this point known. It ranges from 0 to 100 for calls and negative 100 to 0 for puts. And the higher the delta, the more the option price is going to change when the stock price moves. Here's what we're talking about. Think of high delta as like a race car, okay? If your delta is 95 and your call option value when you're buying a call option is $4, if the stock price increases by $1, so every dollar it goes up, the option value that's $4 is going to increase by 95 cents. So our new call option value, if the stock price went up by $1, would be 4 plus $1 times 95 or 0.95. That's the math there. And you get a total value of 4.95. You just add those two together. Now, this is a lot like a race car because when race cars are on a track, they have the premium wheels you can get and they grip the track very tightly. They have very smooth turning and they have better control than your average standard pickup truck or car that you drive on the road now. Race cars have better traction. Deltas are higher. When there's higher deltas, there's more traction. You get more increase in your option value. That's why I like to link this to race cars because there's more traction. You get to capitalize more on this gain. When this race car takes off and goes, it takes almost the entire chunk here of the option change. When we go to a lower delta, it's thinking of your kind of classic sedan with really crappy bald tires. It's not going to capture as much of the delta. Therefore, it's not going to capture as much of the move. So when the delta is only 25, and the call option value still is at 4, and the stock price again still rises by $1, instead of capturing 95 cents, because we have these little crappy tires on here, we're not having a lot of delta. Think of delta as like the wheel thickness or the wheel grade. You're not capturing as much, so you're only going to get $1 times 0.25, so you're going $4 plus 0.25 for a total option value of 4.25. On the flip side, if the stock price was to decrease, it would be the same thing, except it would go from $4 to $3.75 as the stock price decreased. Theta, our big Greek number 2, it is time decay. It is all driven by the expiration date that you select for your options trading. And as time passes, right, the chances of an option being profitable lessens as long as everything else remains equal. So we can see that time decay really accelerates as the expiration date of an options contract draws near, because there's just less time left in the game for your position or the stock price you're looking at to do what it needs to do. Here's an example of how delta works. When you're 120 days away, this curve right here represents the time decay that's going to tick by every single day. I'm going to show you a graph on the next chart showing you actual numbers, how it works over time. But from day 120 to 90, it's not going to happen and not going to really tick by too much. You're going to lose a little bit of value each day. You get to 90 to 60, and you see that curve kind of starts to steepen a little bit. And then we're getting a little bit bigger of a slope. Then from 60 to 30, again, it's starting to really kind of take off. And you see it kind of goes parabolic here at the 45-day range. And then from 30 to $0, it is a very, very rapid descent. And this is where you have to be careful if you're buying options. It's a really good place to sell options. I always target 30 days when I'm selling. When you're buying options 30 days away, it better move in the right direction quickly, because this is a steep drop off and the options value is going to get churned up very quickly if it does not move the way you need it to. So this chart shows different option pricings here on the left side, a little bit different rates for theta. And then you have your estimated 1-day change in the options price, everything else being equal, a 10-day change here on the right-hand side as well. So with an option price of $20 and a theta of negative 0.25, every day that passes, this contract value is going to drop by 25 cents. So after 1 day, 20 minus 0.25, 1975 is the option value. If you were to go 10 days, you'd go 10 times 0.25 would be 2.5, and you subtract 2.5 from $20, leaving you with $17.5. If the option price moves the direction you want it to be, for example, if you bought a call option worth $20 and after 10 days the stock price moved higher, you wouldn't notice theta happening because the delta would be taking over the option pricing change. Theta would still be happening in the background, but you would have made up the loss by the price moving in the direction you needed to do. Our example here was $7.50 with a 10 theta. Every day that goes by, it's ticking down by 10 cents. So 750 becomes 740. And after 10 days, 750 becomes 650, just going 0.10 times 10, which is 1. 750 minus 1 equals $6.50. And then for a really cheap option here, 0.65, if you had a theta of 0.03, again, every day that goes by, you're dropping 3 cents off the option price. So 0.65 becomes 0.62. And after 10 days, it gets 0.35 again. If the stock happens to move the way you want it to, this impact of theta will be lessened. But if the stock price moves against you or doesn't do what you want to do, you will get theta working against you negatively if you're buying options, and you'll have delta working against you negatively. So this could be 1750 after 10 days, or even a little bit lower if the delta is working against you as well. If you're getting value from this video on the Greek so far, awesome. There's more of this content after this short announcement. To go see what is included in the course full on, you can go to www.tradingoptionsdaily.com/options-academy. And if you choose to sign up for the low price of $49, you're getting 5 video modules, everything you need to know about the basics of options trading, plus a bunch of free bonuses designed specifically for you, beginner trader out there. Go check it out. tradingoptionsdaily.com/options-academy. Now back into the Greeks. So to quickly touch on gamma, it is the measure of change in delta over time. So even though delta is a measure of the change of the option pricing, delta also fluctuates, as does theta, as the price of the stock changes. The delta here, it changes as the stock price changes, as we've said, and gamma just measures the rate of this change and kind of provides traders with a future expectation of how quickly the delta may change in the future. So when your options pricing is at the money, the gamma values are going to be highest, which means that there's a higher potential change in your delta when you're selling or buying at the money options. If you're deep in or out of the money, you're going to get very low gamma, which means your delta is not going to change that much. So gamma is not an essential piece to know, but I want you to understand what it is and how it impacts the delta here. Refer back to the slide as you kind of grow in your options journey. Again, it's not essential for new traders, but something to kind of be aware of as you progress. Vega is the measurement of the risk of change in the implied volatility of the stock price. So it basically tells you how much an option price is going to increase or decrease given a movement in volatility. So when you have an option that is being sold, falling volatility or IV or implied volatility is a good thing because it means that the option price is going to decay or decrease quickly. As a seller, that's what you want. On the flip side, when options are being bought, you want in volatility to rise and potentially have greater movements in the stock price. That will benefit the option price for you if you're buying options and volatility does increase. So how this all comes together in terms of what happens for the market when you're buying and selling options, when you have low periods of volatility and you have very short or small expiration dates, like 3 to 5 days, it's going to be super cheap for the buyers to buy these contracts, and you're going to make very low premium as the sellers. This may work for you, but depending on your strategy and depending on your technical analysis of where the stock may go. If you have a high volatility environment and very, very tight expiration dates, again, it's going to be a little bit more expensive for the buyers, and it's going to be a little bit better for the sellers as you're getting more premium for taking on more risk due to the higher amounts of volatility. Now, if you have high volatility and a super long expiration date, this is going to be the most expensive scenario for the buyers because there is a lot of potential that could happen in this long expiration date with a bunch of volatility in the game. As such, there's more risk for the sellers, so they're going to get more premium paid from the buyers to take on this risk. And if you have a period of low volatility with a long expiration date, again, it comes back to kind of being a moderate area for buyers to pay and a moderate area for sellers to get paid. But just know that any combination of these four can be profitable if you have the right strategy, you have setups that you trade consistently, and you have the discipline to impose your will on the market. If you want to have access to more content just like this, plus a bunch of free bonuses at your fingertips, make sure you go to www tradingoptionsdaily.com/options-academy and check out the course in full detail. $49 per person to sign up. You get access forever. I will put the link in the description of this video and in the comments as well. Thank you for watching, and I will see you inside Options Academy. So how do you find volatility for the market overall and for each individual stock to understand where it's at and how it is tracked? Well, each stock has their own implied volatility, or IV, which I'm going to show you on the next slide. And the stock market also has its own volatility index known as the VIX. And each should be monitored from day to day or week to week to understand where the market is in volatility cycles, while it can be low, neutral, or high, and how a stock's volatility can also change or vice versa. On the left-hand side of this screen, you have the VIX. The VIX is the ticker. If you want to add that to your watch list, I recommend doing that. Anything that is 12 to 16 for the VIX is a neutral area. Anything above 16, just a little bit more than this, is inflated. So 20, 22 is greatly inflated or high volatility. Anything below 12 will be classified as low volatility for the market. And again, this is a measure of the volatility for the entire stock market. Sometimes it's referred to as the fear index in the market. It just gives you a snapshot of how much volatility there is in the current trading conditions. In the middle, you have Tesla's option chain for a 37-day expiration, and you can see the IV right there, 44.6% versus Apple, the same 37-day till expiration, and an IV of 21.8%. Why are these numbers different? Well, it's because that Tesla is more of a growth company. It is seen as less stable. Apple's been around much longer, and it's much more established, has a much more stable line of products and services, where Tesla is still in that growth and accumulation phase. For that reason, you have to have more volatility for this kind of stock like Tesla, which means that it's going to cost you more to buy these options versus it is for Apple buying and selling these options here. These are the things you need to track when you're looking at volatility, and these are impacting your trading, because if you want to trade with limited capital, you have to understand which stocks have the potential to move the most, which ones have the potential to have more volatility, and how volatility and pricing is going to change based on your expiration date, based on volatility of the market, and how these things all tie together.